how cross-border banks quietly took control. They didn't arrive with headlines or declarations. They expanded in silence, balance sheet by balance sheet. And before anyone noticed, the system belonged to them. To understand how European banking truly changed, we have to look beyond laws and treaties. Because the most powerful transformation did not happen through politics. It happened through strategy, through banks that realized borders were no longer limits, but opportunities. For most of the 20th century, banking power was local. Institutions grew inside national markets, shaped by domestic rules and protected by familiar regulators. Size mattered, but proximity mattered more. Knowing your economy was considered an advantage. Then Europe opened. Financial integration accelerated faster than anyone predicted. Capital moved freely. Exchange risk faded. Markets aligned. And suddenly, the cost of expanding abroad collapsed. What once required decades could now happen in years. Large banks moved first. They acquired competitors in neighboring countries. They merged operations. They centralized funding while decentralizing risk. What looked like diversification was also consolidation. Fewer institutions controlled more assets, spread across more jurisdictions. At first, regulators welcomed it. Cross-border banks appeared safer. Bigger balance sheets suggested stability. International presence promised resilience. The assumption was simple. Size would absorb shocks. Geography would dilute risk, but power was shifting quietly. Decision-making moved upward, away from local markets. Lending choices were no longer based solely on national conditions. They followed group-wide strategies. Capital flowed where returns looked best, not where economies needed it most. And customers barely noticed. Branches kept their names. Services felt familiar. But behind the counter, the logic had changed. Deposits in one country now supported loans in another. Profits were optimized across borders. Losses, too, became shared. This was not coordination. It was control. A handful of institutions began shaping credit conditions across multiple economies at once. Their internal models mattered more than national policies. Their risk tolerance influenced entire regions. And once that influence was established, reversing it would not be easy, because Europe's banking system was no longer just interconnected. It was concentrated, and the consequences of that concentration would only become visible when the system was tested. Concentration changed how risk behaved. As cross-border banks grew, they didn't just connect markets, they synchronized them. Decisions made at headquarters echoed across multiple countries at once. When strategies shifted, entire regions felt the impact simultaneously. This altered the rhythm of European finance. In the past, local downturns were absorbed unevenly. Some countries slowed while others held steady. But now, lending cycles began to move together. Credit expanded and contracted in waves, driven less by national realities and more by group-wide priorities. Efficiency improved. Resilience did not. Large banks optimized liquidity centrally, cash pooled at the top, then redistributed where models demanded. This lowered costs and boosted returns. But it also meant local subsidiaries depended on distant decision-makers for survival. Autonomy quietly disappeared. When stress appeared, local managers had limited room to respond. They could not raise capital independently. They could not easily retain liquidity. Their fate was tied to groups' overall health, even if their domestic balance sheets were sound. Regulators struggled to keep up. Supervisors still operated nationally, but banks operated as unified entities. Information arrived late. Authorities stopped at borders. In moments of tension, coordination depended on goodwill rather than mandate. Banks understood this imbalance. They leveraged complexity to their advantage. Internal transactions blurred exposure. Risks moved through subsidiaries in ways that were hard to trace. Even experienced supervisors struggled to see the full picture. Meanwhile, market perception shifted. Investors stopped evaluating banks country by country. They focused on groups. A problem in one subsidiary raised doubts about the entire structure. Share prices reacted instantly. Funding costs followed. What had once been diversification began to behave like amplification. The bigger the institution, the more its weaknesses mattered. Scale no longer guaranteed safety. It concentrated attention, fear, and consequences. And yet, shrinking was not an option. Cross-border banks had become too embedded to unwind easily. Their reach was systemic. Their failure would not stay contained. Europe had allowed a handful of institutions to grow into pillars no one could afford to let fall. Control had changed hands, not through conspiracy, not through force, but through structure. And when the system faced its next shock, that structure would decide who absorbed the damage and who paid the price. When the shock finally arrived, concentration revealed its cost. Stress did not spread evenly. It moved through the largest institutions first, then outward. A problem in one balance sheet became a question about the entire group. Markets stopped asking where losses were located. They asked how deep they ran. Confidence cracked at the top. Funding channels tightened. Wholesale markets became selective. Large banks that once borrowed easily now faced rising costs. Smaller institutions, tied to them through liquidity and payment systems, felt the strain immediately. National firewalls failed. Governments discovered they no longer controlled the fate of their largest banks. Intervention required coordination. Delay increased damage. Every decision involved multiple jurisdictions, each with different interests and political pressures. Time became the enemy. As uncertainty grew, cross-border banks pulled inward. They protected core operations. Capital was retained at headquarters. Liquidity stopped flowing to weaker subsidiaries. What had been shared prosperity turned into selective survival. Local economies paid the price. Credit dried up where it was needed most. Businesses struggled to refinance. Households faced tighter conditions. The decisions were rational from a group perspective, but devastating at the national level. Regulators faced an uncomfortable truth. They could not manage systemic institutions with fragmented authority. The tools were insufficient. The rules were incomplete. Oversight lagged behind reality, and reality moved fast. Public trust eroded. Citizens watched governments rescue banks that felt distant and unaccountable. Institutions that once promised efficiency now symbolize imbalance. Questions shifted from economics to legitimacy. Who were these banks serving? And who was responsible when they failed? Europe had allowed financial power to concentrate without redefining accountability. The system worked in calm conditions. Under stress, it exposed its weakest point: control without clarity, integration without governance. And the cost of that mismatch was no longer theoretical. It was visible in lost growth, lost confidence, and decisions made under pressure. The system had grown faster than the framework meant to contain it. And once again, Europe stood at a crossroads, because concentration could not be undone easily, but it could no longer be ignored. The response reshaped European banking power. Policymakers accepted what markets had already revealed. Cross-border banks were no longer just large institutions. They were systemic actors. Their decisions affected multiple economies at once, and their failures could not be absorbed quietly, so the rules began to change. Supervision moved upward. Oversight focused on groups, not just subsidiaries. Capital buffers were strengthened. Resolution plans were designed for failure, not just survival. The goal was no longer to prevent every collapse, but to control the damage when it happened. This marked a turning point. Banks could still operate across borders, but control came with conditions. Transparency increased. Internal transfers faced scrutiny. Complexity became a liability rather than an advantage. Yet concentration remained. Europe did not dismantle its largest institutions. It chose to manage them, to accept their presence while limiting their reach. Stability became a negotiated outcome, not an assumption. The balance shifted slowly. Cross-border banks lost some freedom, but gained clearer boundaries. Regulators gained authority, but also responsibility. Every intervention carried weight. Every failure carried lessons. What emerged was not a perfect system. It was a cautious one, a system shaped by experience, aware of its own vulnerabilities. One that understood size could no longer substitute for resilience. That efficiency without accountability was not strength. Today, Europe's banking giants still influence the continent's financial pulse, but their power is no longer invisible. It is measured, monitored, and questioned because Europe learned something fundamental. Control does not come from expansion alone. It comes from structure, from rules that match reality, from responsibility that travels with risk. And as long as banks operate beyond borders, that lesson remains unfinished. Sometimes the smallest shift in perspective becomes the beginning of a new future. How